Hey, it's Tuesday.
Hey, happy Tuesday, everybody. Welcome back to another episode of Stocks from Scratch. And also, for those that celebrate, happy Patty's Day, St. Patty's
Happy
Day.
say I should have worn a green shirt. I don't know what I was
We, we,
thinking.
both, we both should have. Hey, we have
Come
green on
on.
the colors of people when they comment. So does that count?
Yeah, I think that can count. That can count.
Obviously that counts. Yeah, let us know where you guys are in the world. That always makes us smile to see where people are tuning in from. Copenhagen, India, I see.
We'll
Serbia.
especially point you out if you're from Ireland. Okay,
Yeah,
on
there you
this
go.
St. Patrick's
give you
Day.
a special shout out. Well, Mr. Stoffel, what are we here to do today?
Well, I'll tell you what, we're talking about a company that I've never owned, but I'm curious to see what we find out, and that's Oracle.
Oracle. Oracle is a company that has been a sleepy company in stock for like 20 years now.
I feel like this is what Microsoft was like for me back in 2010.
Yeah.
Like it's been around forever,
right?
But just not really making waves until recently.
Yep, I would say that all that is fair, but let us know in the comments. Do you own Oracle? Is this a stock that interests you? It came across my radar because they have made some significant moves to become a major player with AI. They've also signed some deals with OpenAI, I believe, and I've seen that they have some absolutely massive backlog of deals that they signed, but there's question about, is that money actually going to be there? How is that going to be funded? I do know that this company is spending more on CapEx than it has revenue now, which is a very interesting move.
Tricky proposition.
Tricky proposition is going to say. So anyway, this one is going to be very fun, I hope, to research. Now, on the scale of difficulty here, some stocks are easy, some stocks are hard. My guess was kind of in this range. I think that the core business is going to be relatively easy to analyze, but they are making some significant changes to the business and business model that I think are going to amp up the difficulty level just a little bit.
Yep. So I'd say so far we've got a whole bunch of no's, not a ton. We are going to call out Janie because her parents are both from Ireland on the St. Patrick's Day.
Awesome.
What about you, Brian? I've never owned it.
I never owned it myself. I think I did do an option strategy on it a period of years ago, but I never owned the stock directly. It did look cheap for quite some time. By the way, if you're just tuning in, my name is Brian Feraldi. I've been buying and selling stocks for 20 years. Here are my returns over the last 13 years or so. I'm the blue line.
Yeah, same here. My name is Brian Stoffel. I've been doing this for longer than that chart shows, but that's where I started being able to go back and find my information. I'm the green. The NASDAQ is the yellow. S&P 500 is the red. And I will say this, Brian, we've got a couple people now chiming in that do own the stock, but only 3 out of about 20 that have responded so far.
Okay, thank you. So we're going to teach you in this session how we research a stock like Oracle from scratch. We're going to do so using Stock Simplifier, which is the 7-step process that we built to analyze any company relatively quickly. We are going to be following the framework that we use to analyze stocks, and we are going to be leaning heavily on AI to help us figure out what this company does and more. So I have a copy of the Stock Simplifier spreadsheet opened up. I'm also going to click this button right here to get access to our AI prompts that we have. I'm going to open up a fresh copy of fiscal.ai to kind of get that going. But the very first question that we like to ask about any business is, which stage of the business growth cycle is this company in? This is foundational information that you need so that you can figure out what metrics you should pay attention to, how you should value it, and how you should judge if the company is on track. So for viewers out there, which of these phases do you think Oracle is currently in? And then I will ask AI for its analysis.
I'll say, while you're asking for its analysis, the one thing that's, I mean, to me, I'm agreeing with Olivier here, who just responded, capital return. But it's interesting because you just said capital expenditures beyond what their revenues are. That almost sounds like a stage 2 or 3 company.
Yeah.
That being said, 5 is just kind of what it kind of has to be. And that's what everyone who's responded so far has said, stage 5.
I'm very interested to see what Gemini is going to say, which phase this company is in right now. Okay, so it says capital return. It's highly confident. Why? Because it has positive operating income. Revenue grew 21%, and it is returning capital via a quarterly dividend of 50 cents per share. That means that the trailing numbers, PE, free cash flow, are going to be useful. It has stable operations and capital returns. Current earnings and cash generation are drive the valuation. So here's what they're doing. Oracle is a mature tech company, giant, transitioning legacy software to its high growth cloud infrastructure, OCI. I'm pretty sure that's Oracle Cloud Infrastructure, while maintaining high profitability. The business generates massive cash flow that allows it to fund aggressive AI infrastructure investments while rewarding shareholders, and focus on the core business profitability, ensure the valuation isn't overextended. And the things to watch are the sustainability of capital returns.
That makes sense if what you're saying about their capital expenditures is true.
Yep. So anyway, that's going to be something that we will see there. So there we go. Okay. The next step is to start analyzing the business. So we have a business analysis tab here that kind of breaks down what the company does, the key things to watch, and whether this is a high quality business or not, using a couple of keys. So I'm just going to put that in there. So we have people that identified it as in the capital return phase. And now on the business, these are the things we're going to ask. So how does it make money? What are its key products or services? How frequently do customers buy? And can the company raise prices? So now that had a chance to run, let's see what the answer was. So
did NVIDIA?
It did do NVIDIA. Try again on Oracle.
Whoops.
Yep. That is funny that it did come up with NVIDIA. Good catch, because I would have just kept reading. There we go. Okay, using Oracle's 10K, which was filed in June of 2025. So it's almost a year old at this point, as well as its quarterly report that was filed just a couple of days ago. So that would be much more timely information here. So what does the company do? Oracle provides products and services that address enterprise information environments, including applications, platforms, and infrastructure.
Basically the guts for big companies.
Databases, right? You can't have a software program without a database to store information and retrieve it. So I view Oracle as like the original massive database company. Now the company is currently undergoing a massive transformation from a legacy on-premise software provider to a high-growth cloud infrastructure and AI company. All right. So it has 4 segments: cloud, service, and license support. So this is 64% of revenue. This is the company's largest and most profitable, consistently recurring. Let me just say, and support fees.
Two quick things. If you could zoom in just one more time, because someone just asked if we could. But the other thing I'd want to know is how much of that is the license versus the cloud services? Because that's kind of a big deal if the license is for on-premise stuff.
So on-prem is down here, it looks like.
Okay. Yep. Never mind.
So this looks like cloud, and this looks like on-prem.
Okay.
So there you go. So 64% of revenue appears to be cloud and licensing support for cloud.
Well, that's good.
And then cloud license. So this, and then on-prem. This means, you buy the software and then you deploy it locally. This is only 24% of revenue. So the majority has been moved to cloud.
All right. Well, that's further along than I was assuming it would be.
I agree. Services are additional. This is consulting and education services is an additional 1.4 billion or 8% of revenue. And then hardware is 4% of revenue. Okay. Who are the customers? 430,000 globally customers, ranging from small and medium-sized businesses to nearly all of the Fortune 100. And they're grouped into global enterprises, large companies using enterprise resource planning, human capital management, and database software. AI startups and hyperscalers, so companies like NVIDIA and Meta, have recently signed massive contracts for Oracle Cloud infrastructure. And then governments are public utilities using secure government cloud regions. Okay, where does it operate? 175 countries, 55% of revenue is in the Americas, 28% is Europe, Middle East, and Africa, also called EMEA, and Asia Pacific is 17% of revenue. So a nicely diversified business from a global perspective. Great.
Agreed.
Business dynamics. How frequently do customers buy? Highly recurring. 70% of Oracle's revenue is recurring, which provides high visibility into future earnings. Good to see. Backlog. The company's remaining performance obligations skyrocketed to 553 billion, up 325%.
Now let's just pause there for 1 second, because if memory serves, what I remember is that this came out when earnings came out a quarter or two ago,
Yep.
and it was either OpenAI or Microsoft, or OpenAI via Microsoft, that accounted for like an enormous chunk of it. The stock exploded after there. You can see it right there where the stock exploded after that came out.
Yep.
And then the circularity, or the reliance on just OpenAI, people really started to question that, and it kind of lost all of its momentum that it had from that announcement.
Yep. So it kind of made the announcement. Let's just call that here, right?
Mhm.
And then boom, the stock basically, doubled. And now it has basically given up everything that it had. And it's currently trading basically where it was 2 years ago. But that was quite the surge, getting up to $330 per share. So the momentum crowd really found this stock a few years ago and started to dive deep into it there. So yeah,
But
I
that
think
one day was a huge one, because I remember
yeah,
it was up like 40%.
probably their biggest move in a couple of
Yeah.
decades. All right, next, can it raise prices? Yes. Oracle maintains high operating margin, 43% non-GAAP. That's a big difference between GAAP and non-GAAP.
It is
That
for
I
a
wonder if
company
that's
that
all
age.
stock-based compensation. That seems like a lot. Pricing power is derived from the sticky nature of databases and ERP software, where switching costs are extremely high. Oracle is seeing demand for AI infrastructure exceed supply, allowing for premium pricing on its latest offerings. Okay. What happens in a recession? Historically, Oracle software support revenue has been highly resilient to downturns because they cannot simply turn it off. And while cloud business is growing, the hardware and new license remains cyclical. Heavy capital expenditure for AI. Heavy capital expenditures for AI data centers resulted in 11 billion in negative free cash flow in Q3,
Ooh.
increasing the financial risk of the anticipated AI boom demands software during a recession.
Yeah,
Let's take a look at some of those.
yeah, one other thing while you pull that up that's interesting is, while it kind of sucks to be pretty much on-prem when your legacy during a recession, it's probably better to be on-prem than, because it's easier to cancel your subscriptions, right? Like I just feel like scaling down for a customer is easier if it's cloud-based than if it's on-prem. That's just
Sure. You've already paid for it.
yeah.
So look at revenue growth. So 6% over the last decade. I bet if we zoom into the last couple of years, it's faster, 10%. And if we zoom into the most recent, like just say 2 years, 11% with the bigger
If you
jump.
could, if you
Yep.
could go to the segments and KPIs and just pull up the remaining performance obligations, I think we'll
Oh
really
yeah,
see
that's a good call.
that's
So
that's the one that's gonna be like, wow, what just happened here? It should be right there
remaining.
at the bottom. Yeah. Watch this. Boom.
Holy cow.
Put it on the quarterly view, because I think it all happened at once. Yeah.
Yeah. So remaining performance obligations. This is basically contracted future revenue. So this is an indicator of forward demand. Yeah, look at that.
And then the question is,
Unbelievable.
how real is that? Like,
Yeah,
will OpenAI have the cash to pay for it? Because here's the thing. Oracle is building out to be able to supply that right now. If they build it and no one comes, to use a Field of Dreams analogy, that could be trouble, right?
sure
But if they
could.
build it and people come, then everything's much better.
What's funny about this number is that this number has continued to increase, yet we
Yeah, it's
saw the
true.
volatility of the stock go down
It's true.
substantially here. So that could be the growth rate declining, or that could just be the market saying, hold on, we don't
How
believe you
real?
that this is real.
Yep.
But what they're essentially saying is we have 550 billion in revenue under
$500
contract,
billion.
half a trillion in revenue under contract, and they generate how much revenue per year? This is quarterly.
About
So
80. It's probably in the ballpark between 60 and 80 billion.
yeah. So let's say 64 billion. So we have 9 years of current run rate revenue under contract. The next 9 years, our
How much
revenue is.
what does fiscal say they'll have 3 years from now if you pull that forward? Oh my goodness. Oh no, wait. This is still, we're still
This is
on
still
the
remaining
remaining
performance
performance
obligations.
obligations.
Yeah, they
Revenue is
don't,
what I'm curious
they don't
about.
forecast that, but if we go from a
88.
revenue perspective,
So they do see a
88
big
billion.
jump.
88 billion is the expected number. And remember, these are mid-year fiscal numbers, right? So their year ends in June. So that's why it looks a little bit wonky. But you can see just how much revenue growth this company is expected to have. Just enormous. Okay, so with that out of the way, what do you guys think about this business? Red, you're confused. You don't get it. You don't like it. Yellow, you get it. Looks okay. Green, this is not only a business that you understand, it's a business that is darn exciting from an investment perspective. Would love to know what people are saying about that, Stoffel.
Santos says green. Bruce is on the opposite end. He says red. But we're all over the place here. I'll say this. I always look at this first one as saying, do I want to continue my research?
Yep.
I mean, we're going to do it no matter what I say because we're here. But I would say green. I'm curious.
Recession proof, high margin recurring revenue business always gets me excited. Now it wasn't as exciting before when the growth rate was slower. It was more of a legacy business, but this is a business that is significantly transforming itself. Okay. Next, we're going to take a look at the company's moat. And we want to know red, yellow, green. What do we think of this moat? Now, there are multiple sources of a moat. There are multiple states of a moat, and there are multiple directions for a moat. I would love to know from people watching, what do you think is the biggest source of moat for Oracle today? Do you think it's network effect? Do you think it's switching cost? Do you think it's low cost production, intangibles, or counter positioning? Now, I think I know what the answer is going to be. Or at least I know that I would put on there, but let's go ahead and ask Gemini and see what it says. And what do people think it is, Stoffel?
We've got like 12 people all saying the same thing, switching costs. And I will agree with that.
Yeah, it did kind of say that in the business analysis up top. All right. So this says moat size narrow and the moat direction is stable. Interesting that it wouldn't be wide. Switching costs and intangibles. Oracle maintains a resilient moat built on its mission-critical database software and surging backlog of AI infrastructure, but its cloud RPO has ballooned. The durability of its advantage is under pressure from AI-driven disruption to legacy software models. So this says it's stable, but under pressure from the changes. So narrow and stable is what it says. Okay. Switching costs. They're wide and stable. Oracle's primary strength lies in its extreme difficulty of migrating off its core database. These sticky enterprise are deeply embedded in the workflows, and the recent transition to Oracle Cloud Infrastructure has further locked in customers through multi-cloud partnerships with AWS, Azure, and Google, effectively making Oracle's database a permanent layer within a competitor's clouds. Does this effectively mean that you can offload some of it to AWS or Azure or Google through Oracle? So does that mean they're kind of like Snowflake?
This is definitely one of those where this is good that we don't know this answer, because we're showing that Stock Simplifier is an amazing tool and you shouldn't make your buy decisions just based off of going through it one time.
Okay, well, I'm going to prep that question.
Yep.
Now, the RPO is up huge. Cloud revenue is growing, enjoys deep integration. Okay. Intangible assets are stable and narrow. Oracle possesses a vast network of intellectual property, the Java programming language, and MySQL, and Oracle database kernels. Its brand is synonymous with industrial-grade reliability. This moat is classified as narrow because it lacks the premium pricing power of its peers, and its software patents face increasing competition from open source alternatives. Fair enough.
Yeah, I think that I just to your other question, what Olivier is saying is it's more about the database than it is about the AI infrastructure per se.
For the OCI?
For when the question that you're going to ask it.
Oh,
That it's
okay. It's more about that the database can be accessed through all those platforms than
right.
they're a cloud vendor. Okay. All right, that makes sense. So Elgar has a massive user base of deployments. The prop does not exhibit classic firewall, so no network effects. Okay. Low cost production. They're aggressively scaling a data center footprint to achieve economies. Its Zetascale cluster is highly automated, autonomous database, reduce the human labor required. It lacks the absolute cost leadership of hyperscalers like Amazon or Google. So it did give it some while acknowledging that Amazon and Google have larger total scale. Interesting. And no counter positioning. Let me just, so risks, capital debt, capital intensity debt. Oracle is funding with significant debts, 125 billion, which could pressure its credit rating. Faces intense pressure from AWS, Azure, and Google Cloud. And its PE ratio is high. Morningstar says it's a narrow moat, but it was downgraded from wide just a couple of days ago.
So this is something that you and I and our friend Mr. Withers have been talking about. I would say that Morningstar is a little late to the party, but after the SaaS apocalypse of February, they went back and re-rated a ton of stocks based off of what happened. Unfortunately, this is a classic case of the narrative following price because they didn't do that until after everything started crashing.
I like this analysis right here. Oracle's short-term finances are booming. The fundamental shift from moat is from moat of necessity to a moat of scale, which is more capital intensive over the last. Let me just ask my question just to make sure that Olivier is correct. It's correct. No. Okay. OCI, think of OCI as the shopping mall, the infrastructure, and Snowflake as the high-end specialty store. Okay. So they help to provide the back end. If those other platforms need additional support infrastructure, that's where Oracle Cloud can come in. Okay, good to know. Well, how would you guys rate this company's moat? No moat, or the moat is weakening? Yellow would be it has a narrow moat and the moat looks stable overall. Or green, the moat looks quite wide and it is expanding. Once again, I know how I would rate this. I'm curious if people are reading into this the same way that I am, Stoffel.
Yeah, I know exactly what I would say. We're getting a lot of the responses that exactly match what mine is, which is a stable, narrow moat.
Yep. Moat is shifting. So the legacy business definitely has a wide moat. The new business, much more question. And at the scale that this company is operating at, it is kind of clear that they're almost making a bet the farm situation with the transition to AI, which, kudos to management for doing that. That's not an easy decision to make. And I have
when you're a founder, you can do that.
Exactly. Larry Ellison has the voting power and the clout with Wall Street that would allow him to make that kind of move. This is when having a founder-led management team or founder-involved management team really, really matters.
I don't think you could do this if it was anyone else. I don't think they could pull it off.
Really hard to do this elsewhere. Okay, got that. So let's just say in question. Next is growth. Can this company grow? What is the company's long-term potential? Now, in Stock Simplifier, if we teach you to go to fiscal, and right on the growth page here, they kind of forgive you. Oh, here's what analysts say. So analysts predict 24% revenue growth over the next 2 years. That's significantly higher than its 5, 10, and 3-year growth rate. Earnings are expected to grow 21% over the long term, which I believe is 5 years or more.
Using GAAP accounting.
That's a good point. Using GAAP accounting. Now, I think I know what the sources of that extreme growth are going to be, but let's double check so that we can build the conviction into as why we should believe those growth estimates.
Mm-hmm.
All right. The growth strategy is going to be balanced, explosive new infrastructure, and deep existing application expansion, geographic market expansion, new products, and customer retention. All right. So analyzing using and the recent $50 billion capital funding announcement. Okay. Moderate sales and marketing. While headcount remains high, 50,000 people in sales and marketing, Oracle is pivoting. Yeah, that's a lot, isn't it?
That's a ton.
Oracle is pivoting towards automated AI code generation to build software with fewer people.
There's going to be some massive layoffs at Oracle if there haven't already.
Probably. Strong. New distribution channels. Oracle's multi-cloud strategy has turned competitors into distribution channels. So it's helping to run inside AWS, Azure by Microsoft, and Google Cloud, which are the big three. So
I love that it tells us how much it's growing. I would love to know, how is that needle moving? Because if something's growing 530%, it can't be that off of a huge base.
Right. It probably from a single digit starting price. Geographic expansion is strong. Oracle is in a historic build out, raising $50 billion to expand. It has secured 10 gigawatts of power and is building 47 new multi-cloud data centers. Wow. Acquisitions weak. It made a massive Cerner integration. Oracle has slowed major M&A. It doesn't have money to do M&A if it's spending that much on capital investments. And intangibles include declining. Recent capital is being fueled into organic data center rather than new buyouts. Great. That looks like the right move to me. Yes. Existing customer expansion is moderate. Non-GAAP operating margins remain at 43%. Stellar. AI infrastructure gross margins are AI infrastructure. Gross margin,
but it's going to change, right? Because you've got to pay now for the compute, for the building out your new centers. And like they said, they're not the leaders now. They're kind of in this weird frenemy thing with AWS and Azure and Google Cloud.
So this is important. So this is their current operating margin, 43%. And they say that their AI infrastructure gross margin, which does not include operating expenses, is 32%.
So it's going to drop a lot.
That you would hope that number has a long way to increase, right? As they get more scale. But this says Oracle's cloud economic strategy focuses on undercutting hyperscaler pricing rather than aggressive hikes. So they are in market share grab mode right now.
Yep.
That is also risky from a financial perspective.
Well, it's risky when you're spending as much as they're spending.
Yeah. Again, going all in. This is a bold move. New products and services is very strong. Infrastructure as a service was up to 84%, driven by new GPU-powered AI training clusters and specialized industry SaaS tools like the Clinic AI agent. Okay. And then retention. RPO was up huge, locking in customers for years through large-scale AI and sovereign cloud contracts. So the biggest
real quick,
one,
just because this was Olivier's question, this is almost all usage-based, I'm assuming. Would that be fair to you?
Well, let's ask: is their revenue usage-based or seat-based? Great question.
I've got to believe.
Great question. In the age of AI, I'm also guessing it's usage based, not seat based, but we will double check. Good question, Olivia. Thank you for asking. The geographic market expansion is going to be number 1. Customer retention is 2. New distribution channels is 3, and then untapped is acquisitions. Let's ask that question. This is an important question to ask of every company that does software these days. Okay, it's a hybrid. It's shifting towards usage-based consumption, which makes total sense.
Yep.
Okay. So Oracle Cloud is usage-based. You pay for those things. And Oracle Cloud is seat-based. So their legacy products are still seat-based. And this is the majority of revenue, if I do remember.
I'd have to go back and check.
I'm pretty sure that this was a pretty high number. So that can cause, that's the business that
everyone's dealing with this, right?
It's going to absolutely everybody is dealing with them. The question will be, can they grow the cloud fast enough to offset them losing seats? And the answer is probably. If you're looking as a growth story, it's a usage-based company. If you're looking at it as a utility, it's still a seat-based company. So both, but they're shifting. They're shifting towards the right direction.
Yeah.
Great question. Great question.
But the pace of that shift matters when you're spending. Now, if they weren't spending all the money that they're spending, then they would have some wiggle room. But when you're spending as much as they're spending, they've got to make sure that usage based grows fast enough to make up for the loss of seat base.
They absolutely do. I would bet that they can do it given the insane numbers that they're throwing around for AI, but it is something to keep an eye on. But what do people think? Red, yellow, green for Oracle's growth potential. Is this a low or negative growth potential company, a good growth potential company, or green for great growth potential company? Yet again, I know what I would put for this one, or at least what I'm leaning towards, and I will zoom in one more. What are people saying, Stoffel?
So far we've got a couple. We've got a green. We've got a couple of yellows. Another green. A couple of yellows. Most people, I would say yellowish green. You know, it's interesting because mine was actually going to be yellowish red. But just
explain.
So the reason I would say yellowish red is just because it's more because I need to research more about this OpenAI RPO, because I also know that Oracle, I believe, invested money in OpenAI. And
Probably.
so giving OpenAI the money that their OpenAI can then use to pay Oracle. Like it's and I'm not saying that that's inherently bad.
Would it be fair to say that you're incorporating risk into this analysis?
Yeah, really that's fair. That's fair. I guess without that, I would say yellow.
So yeah, the question we're trying to ask here is just, do they have long-term growth potential?
Yeah,
Not
I would give it yellow.
Adjusted growth potential. It's just, do they have growth?
Yeah.
To me, the answer is green. Yes.
Okay.
How risky is that? That's coming later. But I believe this company definitely has great long-term growth potential given the RPO numbers. Again, whether you believe that will come to fruition is another question.
Sure, that's fair.
To me, it's green.
We're just putting it in different buckets, but we're saying the same thing.
You're risk adjusting it, which is the smart thing to do. But from a checklist perspective, I just want to be consistent. All right. Key metric times. So as a phase 5 company, we're going to check the company's revenue growth on a 3-year basis, net income conversion, EBIT to interest expense. This is a balance sheet check, return on invested capital, and capital returns.
I have a feeling some of these are not going to be green, because I remembered looking at the numbers earlier when you pulled up the home screen.
I totally feel the same way. And the key metrics, all AIs we've found kind of struggle with these. So we will get a quick glance at what AI says, and then we'll double check using fiscal. All right. So revenue growth.
I don't believe that first one.
Yeah. I think it was single digit, right? 7%.
Or over the last, yeah.
So that would be yellow. Free cash flow conversion. Well, we do know that free cash flow has gone. Actually, we haven't clicked onto that yet.
But they said somewhere that it went negative.
Is way negative. But let's pull that up. So this check. So this is why understand the difference between net income and free cash flow is important. So according to fiscal, 16 billion in profit over the last 12 months. 6 billion. And if we compare that to free
oh my goodness. I'm sorry, I just looked at the capital expenditure number. Can you pull up the CapEx number?
I will, but let's just focus on this for a second.
Okay.
So this is reported profits on a GAAP basis, 16 billion. This is reported free cash flow, negative 24 billion. So the difference here is the build outs in the AI infrastructure. So historically, the company converts quite a lot of its net income into free cash flow. So those two things line up. Right now, boy, they do not. They do not at all. And I will pull up the capital expenditure number.
Look at this number. Oh my goodness.
Yeah, this is a company that was doing 2 billion in CapEx 4 years ago. Now 48 billion in CapEx.
I'll make this quick. Brian, do you have any large data centers that have gone up anywhere near where you live?
Not that I'm aware of.
Okay. So this past weekend, we drove up to Door County in Wisconsin, and it was all foggy out. But I know that there's a data center being built about 20 miles north of where I am, and they have a fence surrounding it. That's all they've got so far. We were going 70 miles an hour, and it took us over 2 minutes to drive past the entirety of what this data center is going to be. So it's like 2.5 miles long.
Wow.
I mean, it's the largest building I've ever seen.
That's crazy. So we know that this is yellow and that this is recently gone red. Although, you know, if you want to be generous and say, well, this is by choice, right? This isn't being forced upon them by the market. EBIT interest expense, this is 4.6. This is actually a good one to really dial in on, because I know that they are taking in huge amounts of debt to fund this. So the ratio that we're looking for is going to be under
it's under financial
I think it's
health.
Is it financial health?
Yep.
Yeah, there it is. All right. So
yeah, I got it right.
It did get it right. So 4.7 in the most recent quarter. So this means they're making 4.7 times as much EBIT, or earnings before interest and taxes, as they do with their interest expense. But I have a feeling that this number is going to get worse and worse and worse.
Yeah. Another way to look at that is the inverse, which means 20% of their earnings goes towards paying off their debt.
Yeah. So it looks okay for right now. A return on invested capital. This is making sure that the investments that they're making are generating a sufficient amount of return to justify their capital. Now, again, this number historically was very high, and it's gone into single digits. This is more of a reflection of, hey, they're spending all this money, expanding their capital base, but they haven't generated a profit to justify it yet. So this is going to look bad. And then finally, capital returns. I'll trust whatever the AI says here. So 12 years
I believe that.
Of capital returns. So I have a feeling if we did this 2 years ago, this would have been pretty much green across the board. But you can see how much it's weakening their financial position to go into the situation where they're spending so much on this AI build out. So they're getting riskier.
Yep. Hey, real quick, Brian, just as we're going to move on to the next one, but do you, one of our watchers says ChatGPT gives slightly different answers than Gemini. Is there one that we recommend that we use?
So for the key metrics, I haven't found a single AI that does all of them perfectly. AI seems to really struggle with numbers, and it's doing the calculations kind of themselves. I've personally switched my usage of AI over to Gemini, although literally yesterday I kind of switched to Claude. But we're not using Claude just yet on these deep dives. But it's good for it's funny. AI, I would say, is really good at the story part and horrible at the number part. You would think it would be the exact opposite, but this is why we always check the numbers with fiscal.
Yep. There you go. And I think it's good to always use a bunch of them. I pay for Gemini and ChatGPT and Claude personally.
There you go. All right, moving on to risk analysis. We like to classify risk into three different colors, and all risk in our mind comes down to execution risk. What are the reasoned probability that this company won't be able to deliver the things that it needs to deliver to reward its key stakeholders, aka investors? Now, there are 4 sub-risks that are worth diving into. There's customer concentration risk, disruption risk, outside forces risk, and competition risk. So let's see what AI says about these analysis, and we've
already got some people chiming in too with what they think it'll be. I think it'll be yellow or red personally.
Yeah. I don't know how this wouldn't be yellow at best case scenario.
Yeah.
Based on what we know so far. Okay. So this says medium, 2.25. So just to the right of the midpoint. The biggest risks are outside forces, and it's calling out debt/interest as well as competition. And their huge RPO backlog does provide some visibility. Okay. So concentration risk, not a problem.
I get that. And this might be something where the AI is looking, is their concentration backwards looking and saying no. But you got to believe that open AI is got some concentration risk.
Fair enough. I'll ask that question. Next, disruption risk. Yes. While AI poses a significant threat to its legacy software models, its core wide moat business Oracle has successfully pivoted to being an AI infrastructure provider. Their transition involves circular risks, partnerships like NVIDIA and OpenAI that has drawn investor scrutiny, and rightfully so. These companies are very intertwined with each other. But given the threat that it poses to the company's core business, to me, this is the right.
They don't have a choice.
Yeah, this is the right move to make. It's existential if they don't.
Yep.
Outside forces, red. Oracle has extreme exposure to interest rates due to its burgeoning debt load, raising 30 to 50 billion to fund capex. Credit default swaps recently hit levels not seen since 2009. So yeah, now interest rates are another factor.
Well, you got to imagine that the what's going on in the Middle East, in a lot of ways, can play with investors on this because the interest rates are so important.
Right. So, yeah. So if that causes inflation could lead to higher interest rates. Higher interest rates lead to not good for Oracle.
That coverage ratio is going to get uglier if that's
go in the wrong direction.
Yeah.
And then Oracle faces a normal but intense competition environment against hyperscalers, which are frenemies. And while it's growing, it remains a smaller player with roughly 3% market share in a capital intensive industry. So overall rating, this says yellow, and its highest by its financial leverage. It needs to spend 50 billion just to maintain competition, and it's becoming increasingly sensitive to outside forces. So if demand slows, the debt burden could be huge. Now it does have some defensibility built in, but let's ask that question: is their RPO a concentration and issue?
You know what the funny thing is too? 50 billion sounds like a lot, but that's nothing compared to what the hyperscalers are spending.
Right. Or at least it's not massive by comparison. Yeah. So the RPO is highly concentrated and represents one of the most significant execution risks. While the revenue is diversified, this is because of a small handful. Okay. The driver is large scale AI contracts, OpenAI, Meta, NVIDIA, substantial customer concentration risk. Yeah. So even customer concentration risk it's not customer concentration risk, it's future revenue concentration risk. Yeah. I could say personally, I used to be a very heavy ChatGPT user. I rarely use the app anymore. Now that's me, one person, and I know that it's still like the largest market share player out there, but that does go to show I don't think there's much switching costs at all between these AI models.
I think the more you build on them, it's possible. Like I've spent so much time and Gemini has remembered so much of what I put in. It's kind of a pain to reteach something, but I also think that you're not totally wrong.
Yeah, I think they're very, very weak. So I would love to know what people think here from a risk perspective. We've already got some people chiming in, correct?
Yes, we have. We've definitely had some yellows and reds pop up so far. I'm kind of curious what other people have to say. Olivier points out that energy hikes lead to inflation, which leads to increased risk rates.
Outside forces. Well, yep. let's go back. So concentration risk. This is not green, right? It's I would say yellow, or it is green right now, but it's going to become red. Disruption risk. They've definitely identified it and they are fighting back. So I would say, yellow to red there, but they haven't won. Outside forces. This was not a problem at all before. Debt is making it a problem, and competition looks about normal. Normal to me. I mean, it's no more intense competition than they faced previously. So I think I would go red.
Yeah, I think I would too.
I'm going red here. If you again asked me 2 years ago, green, but this company is definitely become red. Okay. Valuation time. How do we value this company? Well, since it's in the capital return phase, we're going to go to trailing numbers, trailing PE, and trailing price to free cash flow.
But of course, we'll always look ahead too, because
always look at the forward numbers as well, because why not? Okay, so on a PE basis, let's start there. Currently about 27. That's in line with its last couple of years. If we add a midpoint to its graph line on there, Yeah, currently about 32 is its historic norm over the last 4 or 5 years. Currently 23. We should be able to back this up even further. Um, although it was fundamentally a different company back
Yeah.
back
It's
there,
hard.
right? So a
Yeah.
more recent comparison makes more sense. Yeah. So I would
I think
say,
that timeline works.
yep, slightly below its historic average. How about price to free
This
cash
won't
flow?
even, I don't think this will be anything.
Yeah, you're right. It's negative.
Yeah.
Yep. This is why having multiple metrics in mind. So look, you could have done it just fine here, but their capex build has been so big that their free cash flow is now negative. This number is useless for valuing the business. So that's trailing. That's looking backwards. Let's look forwards and see if these numbers make any sense. Does forward price to free cash flow, is that useful? Nope.
Nope.
They're going to be burning capital for quite some time, but the forward PE looks like it should be useful. 20 times forward earnings, 20 times forward earnings. And if we look and compare that to what it's been, right in line with where it's been over the last kind of like 6 years. So this did get up to 50 times forward earnings, currently 20 times forward earnings. I don't think that's all that high in absolute terms compared to the company's estimated growth rate and revenue performance lock in. But I don't, well, I hate to bias everybody. Red, yellow, green. What do you think of this company's valuation today? Red, it's overvalued. Yellow looks fairly valued. Green, screaming by or way below its fair value. My read on this, Stoffel, is first off, we can't use price to free cash flow at all. That's obvious. The forward price to earnings ratio of 20 looks reasonable on its surface, especially compared to its 20% estimated growth rate. But you do have to put some bands and adjust for risk on there, because this company has a lot of risks going on there.
What I would just, for those that are wondering, how can income and free cash flow be so different? Because when they build out these data centers, they can amortize and depreciate all those investments over the number of years that they think that will last. So it spreads it out, so that if they spend 50 billion this year, in real life, in the income statement, it might just be 5 billion, right? Because they're saying, oh, it'll last 10 years or however long they think it'll last.
Well, let's dig into the numbers there. So 16 billion in net income. And then they had 8 billion in write-offs for depreciation and amortization. That number is going up very rapidly. Stock-based compensation is only 5 billion, only in air quotes. That's still going up. That's 30% of their profits. Those are the biggest adjustments. So cash flow from operations is 23 billion, but it's really the capex that is putting them over the edge. So this company used to be doing 13 billion in free cash flow, now negative. So it's really the capex that's causing them to be.
I'll say this too,
between those two numbers.
Brian, when the fiscal year ends this summer, they're expected to have negative 23 billion in free cash flow. When their fiscal year ends in 2027, it's expected to be negative 27 billion. So that's negative 50 billion over the next 2 fiscal years. When it ends in May 2028, it's expected to be negative 17 billion. So over the next 3 years, they're expected to lose over $65 billion in cash outflows.
Okay. Let's check their balance sheet, since this is going to become a concern. 38 billion in cash, or 39 billion in cash and equivalents, and debt 124 billion. I mean, they were pretty indebted before too.
Yep.
76 billion in debt now.
But they had stable, sizable cash flows.
Right. Easy to support. Easy to support them. Anyway, I can't blame them for doing what they're doing.
No,
not at all. But if I was to say, is this company fairly valued or overvalued? My view is fairly valued, personally.
Yeah, that's where I would land too.
I don't think this is a screaming bargain. Given when you adjust for the risk, I think it's fairly valued. For me to get really excited about investing in this company, I would personally want to see an even bigger discount before I would really get excited about it. Okay, so overall, let's do sentiment analysis. Why has the stock price done what we've seen it do over the last year or so? So this is going to go out. It's going to analyze the stock movements. What do analysts think? What do retail investors think? What does the media think? And give it. Why is this? What's the story behind the stock right now? Okay, Oracle has experienced a tale of two halves. A massive AI-fueled rally peaking in September 25, followed by the huge decline as investors grow wary of that massive capex bill and negative free cash flow. Totally fine, totally justified. Their backlog is enormous, but that things could change. So their next earnings is June 10th, and while the analyst target implies significant upside, their average target is 272. Near term is weighed down by high debt, negative free cash flow, and broader macro consequences, which in turn can lead to higher interest rates, which could be bad. So the sentiment on this stock is definitely mixed to bearish right now, which I would totally agree with. So if you want to be a bull, you look at the backlog. If you want to be a bear, you look at the capex.
And the debt.
That's really what it comes down to. Yep. Customer concentration is an issue, especially with OpenAI, which is creating nowhere near enough revenue to keep itself going as a business, let alone pay for all these things that it has to.
Brian, it's really interesting because I was just listening to Stratechery, which I think you're familiar with, and they were talking about how the big mistake that OpenAI made is that they went for consumers, and there just aren't enough consumers willing to pay for it. Whereas Anthropic went for enterprise. And I don't know if you've seen Anthropic's growth. Like, I don't have the exact numbers in my head, but I've never seen anything like it. Like, it is off of a much smaller base, but its growth rate puts what NVIDIA did a couple of years ago and makes it seem like not that big of a deal.
It's such a shame these aren't public companies.
Doubling in a month.
It's such a shame they're not public companies.
It's insane.
Stupid venture capitalists taking all the percentage gains for themselves. Yeah. Anyway. Okay. So taking everything into account, would love to know, what do people think of Oracle today? Red, it's a pass. Yellow, watch list. Green, interested right now. So we determined that this is a phase 5 capital return company, although they are going to be moving backwards down the business growth cycle. It's an exciting business, a decent moat that has some shakiness to it. The legacy moat is fantastic. The new moat is under question. Great long-term growth potential, mixed key metrics, but moving in the wrong direction because of understandable reasons. Execution risk is high, fairly valued stock today. What do people say, Stoffel?
We're getting the best, the biggest, the most often used one is red, pass. And I would say pass too. The big thing for me is I'm not getting paid enough with the valuation for the amount of risk I would take on. That's now, again, this is my first pass at Oracle. So I'm just telling you what an hour's worth of research does. If I dive into this, I might change my opinion, but that's what on the face of it, I would say.
That's where I would land too. For me to take on the amount of risk that you would have on, I like to look at the market cap. So this market cap is like 400 billion, right? So what would be a really, really great outcome here? This company doubles?
Being where it was 6 months ago?
Right. If it was where it was 6 months ago, you get a double, and that would be $1 trillion company. I mean, we've seen multi-trillion-dollar AI companies. Can this company get that much excitement going about it, given the negative free cash flow and stuff? So you're betting very much on the fervor of AI respilling back into the company for it to inflate its stock price. Can that happen? Absolutely. Is the growth there long term? It very much could be. But when I take on that level of risk, I want my upside to be multiples of my investment, not market outperformance. Personally,
totally agree.
That's the way that I view it. So, all right. Well, thank you guys so much for joining us today. Now, we do want to give you a sneak peek about the upgrades that we have coming to Stock Simplifier. We've been working for months making it way better, way prettier, and way easier to use. So here's a look at what is going to look like once we do make the transition in a couple of weeks. So here's the page where you just confirm, yes, this is the company that I'm talking about. Here's where we show you what the business does. I love that we built in, you can easily compare it to the market over short periods of time. We have the mission statement on here, the date that it was founded in there, and the compound annual growth returns. And then we have these beautiful visuals that show you things like, what are the company's service versus hardware components? Where does it sell its products or services broken down geographically? And then the analysis that the AI does is presented to you like this. So with simple red, yellow, green. So very simple question followed by red, yellow, green analysis. And Brian, perhaps the best thing about Stock Simplifier, in my opinion, the thing that I think we get really right is the AI helps you with the analysis, but you're the one that's making the final call.
That is the most important part.
Right. So the AI should be there to help you gather the information, but you have to make the final call. So on every step of the analysis, we ask you this on a scale of 1 to 5. How interested are you in this company? Or what do you think of this company's moat? Or what do you think of this company's growth? Or what do you think of this company's management team? So that allows you to fine tune your analysis. So that way, as you're using the tool, you're actually building conviction. It's not just a data dump of information. You're building conviction as you go. So you can get the true story. AI can help you get information, but it can't help you build conviction on the inside. That's what we are designing Stock Simplifier to do. We don't think there's anything else on the market that is like this.
And the key is that you layer in everything that you know too.
Right. Exactly. So we make the finding the data easy, and it's up to you to actually build the conviction. It's the only way you can build conviction with stock investing. So from a timeline perspective, in April is when we're going to be giving people that have already bought the first version of Stock Simplifier the ability to upgrade to the new version. And in May, we're going to be releasing it to the watch list. We're doing a staggered rollout just so we can make sure the systems are working perfectly. If you have not purchased the current version of Stock Simplifier, that's perfectly fine. I would encourage you not to purchase the one that we have out there on the market today. Just go to longtermmindset.co/waitlist, or you can go to stocksimplifier.com, join the waitlist. These will be the first people that first get access to the new system, and we will make sure that they get a fantastic price for wanting to do so. So we cannot be more excited about launching this thing.
I spend time on it every day.
What?
I spend time on it every day. And you said that's the goal, right? Like if I'm using it every day, I think a lot of people are going to use it every day.
If we can change your behavior, because you are very stuck in your ways, if we can actually change your behavior to make this a tool that you use to research companies, well, that to me is our North Star for is this thing actually helpful for changing your decisions. Now, we have lots more coming in the weeks ahead. We're going to continue to tease and show you some screenshots of what we're working on, but we've been working with it and tweaking the tool every single day in the background. And I can't believe the quality of the analysis that we are getting out of the tool. It is outstanding. So we do hope if that interests you, you do join the wait list. We will keep you up to date via email with more specifics on dates, times, pricing, and all that kind of stuff. Yeah.
All right,
great. Well, thank you guys so much for joining us today. We will be back next Tuesday, the 24th, with another deep dive into a stock from scratch. We will be putting the stocks for voting in tomorrow's newsletter, the Long-Term Mindset newsletter. So let us know what stock you are interested in seeing us research from scratch next time. Until then, have a great day and happy St. Paddy's Day, everyone. Bye.